Welcome back to the deep dive. If you're trying to stay ahead of that high-growth curve, well, the last 72 hours just handed us a mountain of data.
It really did.
We're talking news, SEC filings, analyst calls, covering 18 key companies. This is all from January 13th through the 16th, 2026, across Fintech, Proptech, and the consumer sectors.
That's right. And our mission today is pretty straightforward. We're giving you the ultimate shortcut. This was an intensely dynamic period, and it was really defined by three themes that were just pushing and pulling the market.
Okay, what were they?
First, a huge crypto market rally that drove transaction volumes way up. Second, some really aggressive corporate financial engineering M&A, restructuring, and maybe the biggest thing, a surprising amount of regulatory and legal pressure that's hitting valuations directly.
So our goal is to distill what matters most for you. We're getting right into the specific numbers, what these filings actually mean, and, most importantly, where analysts are just completely clashing. Okay, so what does this all mean for the big movers? Let's unpack this, starting right in the fintech frontier, where AI seems to be rewriting the rules of lending.
Absolutely. I mean, when we look at high-growth fintech, AI isn't some future concept anymore. It's the engine right now. We saw Upstart or upst being highlighted by places like Motley Fool as one of the few AI stocks, genuinely capable of that 10 times growth by 2036.
And Truist Securities is still holding their buy rating.
Which just reinforces that narrative. This is a long-haul AI bet.
And the response from competitors is immediate. It shows that execution's everything. Just look at Affirm, AFRM. They didn't just tweak their AI. They launched this next-generation smart underwriting system.
Yeah, and that uses real-time bank data straight from the consumer.
So this is more than just a small update.
Oh, way more. They're trying to hit the holy grail of lending, give more people approvals while at the same time, cutting down the delinquency risk for the lender.
But hold on. If everyone's using AI models, how does a firm keep a competitive edge? I mean, isn't the basic data pool for underwriting pretty much the same for everybody?
That's the key takeaway here. It's not about the data pool. It's about the pipes and the speed. By pulling in real-time bank data, Affirm is basically saying they're not just a better buy now, pay later provider. They're a superior AI risk engine.
So they can analyze volatility and capacity instantly.
Exactly. And that directly challenges the old, slow, backward-looking models that legacy credit bureaus are still using.
That makes a lot of sense. And the market confidence seems to be there. I mean, you have that tech upgrade plus the 5-year extension on their exclusive Amazon partnership.
Right, and Evercore ISI is backing them with a $95 target, which shows some serious faith in that model being different.
Okay, so moving from tech to some massive financial engineering. SoFi made a huge move.
A very significant capital action. They finalized the sale of 57.75 million common shares at $27.50. That is a massive injection of liquidity.
And at the same time, they're moving into digital assets. They launched the SoFi SD stablecoin. And you highlighted that it's the first one issued by a nationally licensed bank. So what's the big deal about that national license?
The national license means it operates under a regulated structure that U.S. institutions get, they're familiar with it and they trust it. That regulatory comfort is a huge differentiator from all the non-bank stablecoins that are still facing so much uncertainty.
So it's not just a consumer product?
Not at all. It's a strategic move to build institutional confidence in their digital asset arm. We're also watching January 26th very closely for their Q4 earnings. That's when we'll see how this new capital is being put to work.
Right. Meanwhile, Chime, or CHYM, which IPO'd back in June 2025, seems to be settling in. The analysis suggests that even after that lockup expired in December, long-term institutional buyers are sticking around.
And that's backed by their, 8.6 million active users? It just speaks to the staying power of these challenger banks once they capture that market share.
But stability is definitely not the mood in the regulatory segment.
No. When we look at Block, SQ, and Coinbase, CoinN, we see just how high the stakes are legally and regulatorily.
Let's start with Block. They're dealing with a real duality right now. On one hand, you've got this proposed Trump administration policy to cap credit card interest rates at 10%. That's seen as a huge potential upside for them.
It is a profound policy tailwind. I mean, think about it. If consumers face caps on traditional credit cards, they might just pivot to non-bank payment systems like Cash App, which operates outside those specific rules.
So that could really accelerate Cash App's monetization.
It could, significantly. But then, at the exact same time, this immediate negative risk drops. The securities class action lawsuit against them was not dismissed.
And it's going to trial. The update was on January 14th.
Right, so this dichotomy means Block's valuation is now less about their internal execution, which has been good, and more about these external factors. The political timetable in D.C. for that rate cap, and the judicial timetable for the lawsuit. It creates the highest level of volatility for investors.
That is an intense risk profile.
Yeah.
Now, Coinbase, Coin, is just riding this massive Bitcoin wave. It hit, what, $97,000?
Yeah, driving incredible transaction volume for the exchange.
And the market response to this is completely polarized. Bernstein came out with a super bullish $440 target.
They're essentially pricing in continued mass adoption, catalyzed by this rally.
But then Oppenheimer immediately countered with extreme caution. They warned about short-term adjustment risk. What exactly are they pointing to? Is it just valuation or something more fundamental?
It's mainly valuation and timing. When volumes spike that fast, there's always a risk of a liquidity crunch or just a PE hangover if the price gets too far ahead of sustained institutional money coming in. They're basically saying $97,000 might be a temporary high.
Okay, so a short-term adjustment is needed. And what's fascinating is Coin's own proactive regulatory stance. They publicly withdrew support for a crypto bill, saying, quote, "No bill is better than a bad bill."
They're actively trying to shape the legislative environment. They're demanding quality over speed, and that's a pretty sophisticated long-term strategy that you don't see from a lot of other players who are just reacting to headlines.
And of course, that crypto boom ties directly to Robinhood, AIC.
Absolutely.
Analysts are expecting huge transaction volume and ETF fee revenue for them. And it looks like institutional money agrees. Vanguard and BlackRock both increase their holdings.
Exactly. Fintech is just this intersection of rapid AI innovation and these incredibly powerful and sometimes totally contradictory government and legal pressures.
Which is a perfect lead-in to the challenges in Proptech, because policy is just as dominant there. So let's shift gears to real estate, starting with rocket companies, RKT. There's a huge policy driver here, too. The Trump administration's proposal to buy $20 billion in mortgage-backed securities.
This is a textbook example of a policy proposal that instantly changes a company's trajectory. That action is designed to pump liquidity into the mortgage market and push rates down.
And the immediate expectation is a boost to RKT's lending volume.
Of course, lower rates always trigger more demand for refinancing and new home purchases.
On the M&A side, you have Compass, COMP, trying to manage this massive integration after their $7 billion merger with Anywhere Real Estate. That's got to require some serious cash.
It does. Post-merger, it's all about financial engineering to stay liquid. So they issued $850 million in new convertible notes to secure operating funds. That's a key move for short-term stability while they try to digest such a huge acquisition.
Moving to the macro view, Zillow, Z, gave a kind of tepid outlook for the U.S. housing market. They're predicting only, 1.2% growth in home values for 2026?
Yeah, but they did name one surprising hotspot, Hartford, Connecticut.
That's an interesting local detail. But from a technical side, you said Zillow flashed a warning signal.
It did, a notable one. Falling price despite rising volume.
Can you break that down for us? What does falling price with rising volume actually indicate?
It's a classic technical warning. It means that while lots of people are still actively trading the stock, which is the rising volume, the overall underlying conviction is weak, which pushes the price down. It suggests there's internal selling pressure that the general market interest is kind of masking, and it often comes before a bigger downward move.
That's a critical insight. Now, CoStar Group, CSGP, is dealing with a big internal valuation debate. And they made a huge defensive move.
A huge one. A $1.5 billion share buyback plan. They're basically trying to put a floor under the stock.
And the valuation conflict is so clear in the analyst reports. Some say it's fairly valued based on discounted cash flow, DCF, but others are arguing it's like 9% overvalued.
And that disagreement stems almost entirely from their massive investment in Homes.com.
What's the specific hurdle there? Is it just the size of the investment?
It's the timeline. The market is struggling to square this huge investment, which is a long-term capital expense, with the fact that management has signaled it won't really start paying off until its 2030 profitability target.
An 8-year runway.
Exactly. That's the core of the conflict. Investors are getting impatient about the immediate cost versus that future promise.
Okay, before we leave PropTech, a couple quick notes. AppFolio, APPF, confirmed their Q4 earnings date for January 29th. Sentiment seems pretty positive around their new CFO, Fei Goon, who's all about efficiency-led growth.
And News Corp, NWS, just keeps on with their capital return program, buying back shares under those two $1 billion authorizations.
Which is a strong signal of balance sheet health.
Especially in the volatile media sector, yes. It shows a lot of management confidence.
And that brings us perfectly to our third segment, streaming, brand strategy, and consumer turmoil. Let's start with the media battle, dominated by Disney, Diz. They're making two really interesting strategic pivots.
Right. First, they're trying to fix brand consistency with a new enterprise marketing organization. But the real push, I think, is for daily engagement. They're planning to put a TikTok-style vertical short-form video feed right into Disney Plus Fab.
So they recognize that just having a big library isn't enough anymore.
Exactly. You have to fight for eyeballs every single day. And linking back to AI, that OpenAI partnership should start bearing fruit soon with Sora content expected on Disney Plus in early 2026. That could be a massive differentiated content advantage.
Well, Disney's focused on content. Roku, R-O-K-U, had a governance headline that shook investors.
Yeah, CEO Anthony Wood sold about $8.22 million in stock near the 52-week high, and that caused immediate volatility.
That kind of insider sale always spooks the market. Was it right to be nervous, or is this just a CEO taking some profits?
It creates a negative perception for sure, but the analysts seem to be betting on the fundamentals. They are still overwhelmingly positive. They're all pointing to 2026 profitability expectations. Wells Fargo kept its overweight rating. Citizens raised its price target to $145.
So the narrative is the company's executing, the sale is secondary.
That seems to be the bet.
Meanwhile, FuboTV did some smart financial engineering. They redeemed $140.2 million in 2026 convertible notes.
And crucially, they funded that with the term loan from the Hulu Plus Live TV deal. This really reduces their immediate debt risk and improves their overall financial health. It's a big step away from that high-risk category they were in.
Okay, shifting to consumer goods, let's talk high-growth coffee. Dutch Bros, BRS, is pushing east aggressively. They announced their first major M&A since their IPO, buying Clutch Coffee Bar.
20 locations. It's all about accelerating their expansion on the east and southeast coasts. And analysts love their strategy because the growth is coming from pure traffic, more cars in the drive-thru, not from just jacking up prices.
And that signals sustainable demand.
A very rare and highly valued metric in the restaurant industry right now.
Now contrast that momentum with BellRing Brands, BRBR. Things got really messy for them. Multiple law firms initiated securities fraud investigation.
Yeah, this is over alleged issues with inventory levels and the transparency of their revenue reporting. The stock immediately hit a 12-month low.
This goes right to the heart of corporate integrity, doesn't it?
It really does. This isn't just some accounting error. A securities fraud investigation challenges the trustworthiness of everything management reports. So now they have to face their Q1 earnings on February 3rd under this massive legal cloud. It creates extreme uncertainty.
A perfect example of how governance can just derail performance. On the brighter side, Celsius, CELH, seems remarkably resilient against all this talk of consumer softness.
It really is. Analysts kept their top pick status, calling the stock undervalued, with cash flow estimates pointing to a fair value somewhere between $71 and $82. Their brand strength is clearly overcoming broader economic pressures.
Looking at retail tech, Wayfair W hit a 52-week high, $118.35. That was driven partly by their Google AI partnership, right? The Universal Commerce Protocol.
Yes, and that's all about delivering seamless checkout right inside Google's apps. That AI integration is key. Seamless checkout means higher conversion rates, and they're basically outsourcing that friction point to Google, a very smart move.
Instacart, though, is facing a pretty big risk. An investigation by the New York Attorney General into their algorithmic pricing.
The practice of charging different customers different prices for the same items. The legal issue here is all about fairness and transparency.
But despite that regulatory friction, technical analysis suggests Cart has secured a strong support line for a long-term rally.
The market seems to be betting that their tech infrastructure is strong enough to overcome these pricing governance concerns in the long run.
We should also quickly mention the smaller stories that fill out the consumer picture. Lovey, used their conference presentation to focus on the EverCouch platform and supply chain efficiency.
And Oatly, O-T-L-Y, set their Q4 earnings for February 11th. The focus there is all on their China strategy and new product flavors like Oob and Pandan. They're trying to innovate their way into new markets.
Finally, we saw these dual signals and lifestyle brands.
Yeah.
Deckers, DECK, saw huge institutional buying, which should be great, but then they got simultaneous analyst downgrades.
And on holding, OUN highlighted triple-digit apparel growth and APAC expansion, but still got hold ratings. And why? Purely caution around their high PE ratio. Again, it's innovation meeting valuation caution.
Let's quickly wrap the rest. Lemonade, LMND, had a fantastic 2025, a 120% stock rise, and the gross loss ratio improved significantly down to 67%. That's fueling a lot of optimism for sustained income this year.
Duolingo, DUOL, announced a CFO transition, but the market saw it as just organizational restructuring, not a sign of weakness, especially with their robust Q4 results.
Then there's Carvana, CVNA, where the overheating debate is just raging. The PE ratio is over 100x now after the S&P 500 inclusion, all driven by massive sales expectations. It's a huge recovery story, but does that valuation make any sense?
It only makes sense if you fully believe they've solved all their supply chain and inspection issues and have a clear path to dominating the market. That PE reflects pure speculative excitement. It's priced for absolute perfection.
And lastly, InMode, INMD, got a technical downgrade to sell candidate after its preliminary Q4 revenue guide disappointed analysts who were looking for stronger momentum.
That was a purely numbers-driven call based on an insufficient growth rate, even though the overall revenue figure was still healthy.
So we just cut through 72 hours of news on 18 companies, and the speed of change is just staggering. We saw AI integration becoming mandatory, from Affirm's underwriting to Wayfair's checkout. We saw decisive capital moves like Fubo cutting debt and SoFi funding its expansion.
And critically, we saw how acute these regulatory and legal challenges are. Block facing a policy tailwind and a legal headwind at the same time, and the deep governance concerns hitting BellRing Brands with that fraud investigation.
If we connect all this, the common thread seems to be how quickly governance issues like the BRBR investigation or the ROKU insider sale can just completely overshadow exciting innovation news, like Disney's vertical video or Dutch Bros' M&A.
The market is clearly prioritizing compliance and transparency right alongside innovation. And when you look at the sheer range of outcomes we just discussed, from a potential 10% interest rate cap helping Block to a $20 billion MBS plan boosting Rocket, it forces you to ask a question.
What's that?
What specific piece of government policy, whether it's planned or already enacted, currently holds the most power to instantly redirect the entire trajectory of the Fintech and Proptech sectors? That's something for you to mull over on your own.
That's a deep dive for another day. Thanks for joining us.
Until next time.